Hi guys, welcome back to Trademanza's weekly educational video where we bring to you interesting things about the different companies listed on the Indian market and how you can do trend analysis so that you can profit in all types of market. So in last week's video, you remember I mentioned that now we are done with the basics of support and resistance and moving averages, and we can finally start moving to some complicated things such as indicators, right? So one of the most used indicators out there is the RSI. So in this week's video, we're going to get started with the RSI. Now, before we get started with today's video, do subscribe to our channel, switch on notifications and like our videos because we're going to bring you interesting content like this every week. So now let me go ahead and add the RSI indicator here, right? As we can see from the name shown here, the RSI stands for the Relative Strength Index. Now, what is this indicator and what does it mean? This indicator is basically a momentum indicator, right? So what it does is that it tells you the momentum in the market. By that, what I mean is that there is a formula which calculates the value. You can see that the values here range from, right now you can see 30, but actually there's 10 and 20 below here as well. And these values range from 0 to 100 basically. So how these values are calculated is there is a back-end formula. We don't really have to get into that. But the two numbers which are taken into account when it calculates the value using the formula is that the average gain and the average loss. And as we can see here, now it says RSI 14, right? So what this means is that it's looking at the average gain and the average loss over the last 14-day period. That is because I'm on a daily time frame. If I switch to a 15-minute candle time frame, it's going to look at the last 14 candles of 15 minutes each. So this number here basically represents what sort of candles it's going to take into account when calculating the value. So now if the market has only been going up, which would mean that the average gain is more than the average loss, the RSI will also be going up, indicating that there is strong bullish momentum. Whereas if the market is going down, in which case the average losses will be more, the RSI will also be heading downwards, indicating that the market is in a downtrend, right? So let's get started with the most basic strategy which most people use while using the RSI is that we can see here that by default, there's a dotted line right here at 70 and then another dotted line at 30. So what this number means is that when the number goes above 70, right, when the RSI is usually above 70, anything is considered to be overbought. What it means is that the momentum has increased too much and it means that maybe we could see a pullback. In some cases, that pullback does not really happen, and it doesn't mean that as soon as you see RSI going above 70, you try to short a stock. What it means is that the move is really overbought now, and buying now might not be a good chance. It doesn't mean that you short or something. It just means that at this point of time, you should probably stay out of the trade because as we discussed in last week's videos, if you enter a trade right at the top, you're not going to have good stop loss levels. So an RSI above 70 usually indicates that the up move has already happened and it is better to just sit out and do nothing now. Whereas an RSI below 30 indicates that the market is extremely weak. Now, once again, this does not mean that you go and short it as well, because an RSI below 30 usually means that the bearish move has already played out. So now you must be wondering, if you can't short when the RSI is 70 and if you can't, go long when the RSI is above 70, then what is one supposed to do with the RSI? Well, what the RSI helps is, it helps us catch trend reversals, or it helps us find out places where we can short or go long. So now let me switch to an hourly time frame and show you something very interesting here. If we switch to a 1 hour time frame, I have the 14-day RSI selected here, right? So now what you will see is that every time the RSI has a really big dip, right? Like as soon as there is a very big dip in the RSI, let me just switch to a daily time frame. I think we'll get a better idea that way. Yeah, let's see. So, 50 is usually taken as the median value, which is obvious considering that the values range from 0 to 100. 30 is considered very, very oversold, but let's ignore 30 for now. If we focus at the value of 50, we can see that usually when the RSI value goes below 50, we can see the RSI going below 50 here coincides perfectly with this, right? Again, we can see that the RSI going below 50 indicates with all of these down moves. What it means is that when the RSI is below 50, now you want to start looking for buying opportunities, right? Because an RSI below 50 would usually mean that the market is oversold and maybe the buying pressure will start coming in now. So an RSI below 50 is not an indicator to sell, but instead it is an indicator to go long. By that, what I mean is that let's suppose we see this red candle here, right? Now after this red candle, what you can do is, because the RSI is already oversold, you could wait for the next coming candle to break above this candle's high, and that is when you could take your long entry, right? Which would mean that the bearish move is over and now you can start going long in the stock. As we can see here, if we went long at the break of this candle, we would have caught a very nice up move, right? Similar case happens here. Whenever RSI is below 50, instead of going short, you want to look for buying opportunities. If we entered over here, suppose when the RSI is below 50, we go long somewhere here and we look at the previous swing as our stop loss, right? We enter here at 14,100 levels and we keep this as our stop loss, suppose, which is 13,800, right? Then look at how much of the possible up move we would have captured. So when the RSI is below 50, you want to look for buying opportunities. Whereas if the RSI is very high and you start seeing a lot of red candles in a row, then maybe you can finally short, keeping the next support level as your target, right? What I mean here is that let's look at this. What can we look at? Let's look at a good example. Yeah. Now here we can see that what happens is that the market is continuously going higher and higher, right? But in each swing, the RSI is showing that it is already very oversold, right? Even though the market goes higher over here, the RSI has managed to stay at the same level as the previous swing. In the next swing, the market goes even higher, but again, the RSI stays at the same level. And then we see one very bearish red candle. So what can we do? Below the low of the bearish candle, we can take a short position with the high as our swing and maybe capture a down move up to the moving average. So now we've discussed what is the most basic strategy to use RSI. Mostly RSI is used to catch trend reversals, right? Now another thing I want to talk what the RSI does is that you can also find out how much strength an uptrend has, right? Like what I mean by that is when a market is only going up and up and up, every time when it does come back down, the swing low which it makes is going to be higher than the previous swing, right? We discussed that is one of the first characteristics of an uptrend. So what's going to happen is that the RSI will not really go very low. We can see here that in this entire up move here below, if we ignore these candles here where the trend was finally broken, if we look at all of these candles here, the market has been going up, whereas the RSI is also making lower highs. So the RSI is used to find out the momentum and the strength in the market. Now another interesting thing which you can do with the RSI is that let's suppose if I am to change the period from 14 here, right, to I would change it to 200. Yep. Now this is looking like a very weird chart, but many people have this very unique strategy which they use. That is, if you have such a long-term period for your RSI, right, any value of the RSI above 50 would indicate that the market is in a very strong uptrend. This is somewhat of a rule and a very back-tested strategy, and one can, follow this strategy. That is, if on a daily time frame and with the RSI being 200 period, as long as the RSI is above 50, the market can be considered to be in a very strong uptrend. So any pullback you see, you want to go long at the pullback with a good stop loss. You want to look only for buying opportunities, not for shorting opportunities, because the market is in a very strong uptrend. And on a daily time frame, once we see that the average, the RSI is below 50, we can start looking for shorting opportunities as well. So guys, that's the basic use of the RSI. Now I'm going to tell you one more thing. Not just for spotting like buying opportunities in a basic trend reversal, how one can also know when to exit a trade using RSI. Till now we were discussing how you can enter a trade with the help of the RSI because it will tell you when to go long, right? But it can actually also help you find out when to exit a trade or when you can take very good short positions. So I'm going to show you something interesting here, right? Let me take the RSI back to the default setting. Most people prefer using the default setting as well, but again, like we discussed in the previous videos, these specific values for these indicators are going to depend on how you want to trade and your strategy. Now let's look at this, okay? Let's look at it from a very zoomed out long period time frame. We see that Nifty makes a swing low over here, right? So we can see that the low it makes with the RSI is somewhere close to 35. Then the market goes up, the RSI goes up and makes a higher high. And when the market does correct a little bit, the RSI again, instead of going all the way to 36, it finds support at somewhere close to 48 or 50. So like we mentioned, the RSI would be below 50 and then we would be looking for long opportunities. And if we went long, we would have captured a very big up move. But now there is a secret trick in the RSIs. It is called divergence. So divergence can actually help you spot a trend reversal before it even happens. What I mean by that is, look at this very carefully. So after this up move, we can see that the market goes up all the way till here, right? We have a very nice up move in which the RSI makes a higher high as compared to the previous one, right? In the previous swing right here, RSI made a high of 70, whereas now it's at a high of 80, right? Then we see the market come back as usual. Maybe you would look for some pullback or buying opportunity and you would go long and then, the market would go up. But what is very interesting to see here is that even though the market has made a higher high, and it is actually much higher than the previous swing, right? The RSI has made a lower high. This thing is called a divergence, and this is something which lots of experienced traders use to find out trend reversals long before they happen. And if you can, incorporate the habit of spotting these type of strategies, you will be able to master your exits from trade perfectly. Because what happens many times is people enter a trade, they go long, the trade goes in their direction, and then boom, the reversal happens so suddenly you don't even have time to get out of it. So you can do two things. The first thing could be you could incorporate some sort of rule that as soon as the RSI is above 70, you can consider it to be overbought and you can close the trade and take your profits and get out. But if you want to let your profits run for as long as possible and use the trailing stop loss strategy we talked about, then you need to use the RSI as well and see that if the market is going higher and higher, is it being supported by the RSI as well? So here we can see that the market makes a higher high, but the RSI has made a lower high. This indicates that the buyers are starting to come, into pressure. And what we can see in the next coming few days is that this was followed perfectly as Nifty had a very big correction of almost 15%. Another interesting thing once again to see is that if we look at this swing right here, right, where the RSI made the high, then Nifty had a very big up move. But even after the up move, the high made by the RSI is very low as compared to the previous high. These kind of divergences are called bearish divergence. So in simple words, what a bearish divergence shows us is that a trend reversal might be coming and we should either, book our profits or try to look for shorting opportunities. So guys, that's it for this week's video. Stay tuned into our videos every week because this was just one of the many indicators we're going to be discussing. And in the next week, I'm going to be bringing to you the MACD indicator.